Suicide valuation. Don't fall prey. Recently, we talked about the strategy of raising a Series A, growing, raising a Series B, growing. You get the idea. This is a classic Silicon Valley venture capital strategy, and we see many attempts to imitate it globally, especially in Asia. But the problem is that the VC goal is to just find one or two companies that can IPO or sell for $1 billion after 4 or 5 rounds of investment. Most of their portfolio is just cover fire or fodder for those 1 or 2. Your goals and needs as a founder are secondary. Meanwhile, each round raises the price, constantly moving your goalposts of success further and further away. We see hundreds of founders stuck in what we call suicide valuations, with perfectly good companies that will never be able to sell at the value the investors need. This strategy is ultimately only beneficial to deal makers who get a commission on every round of funding, happy to constantly mark up your value in their portfolio. They win, you lose. This approach takes a terrible toll on you as the entrepreneur because you spend so much time raising money, dealing with new investors, and these charlatan advisors who claim to have your best interest at heart. They don't. Too often, your technical strategy that you've proven locally can be imitated by others with a much bigger global dominant view, with billions in mega financing from private equity firms. That's how the game is played today. They can overwhelm you. Now what's your company worth? Then there's a suicide valuation problem. What do I mean by that? Simply put, the constantly increasing rounds of investment put your valuation way too high. Not only do you miss the option to sell early as a bolt-on or to do a recapitalization, but you may never be able to sell or go public or even raise more money unless it's a down round. That's why we call it a suicide valuation, because it kills your future. Let me give an example. I just ran into a heartbreaking situation where a great little company has been on this track of constant rounds of new funding. Their financial advisor addicted to the commissions. Now they reach the suicide valuation level. Let me explain with some simple math. Let's imagine you've done 2 rounds of financing, each successively higher in valuation over the past couple of years. For simplicity, let's say there's a pre-money valuation was just under $7 million for round 1, $20 million in valuation for round 2, and now you're trying to raise money at a pre-money valuation of $40 million. If you raise $10 million, then the base value of the company is now $50 million, right? 40 plus 10 equals 50. Except that the new investors would never sell for $50 million. They want at least double or even a higher multiple. So you're looking at a sale price of at least $100 million for the last investors in to be happy. Way too high a valuation, which you won't achieve for many years, if ever. And you've been further diluted owning a smaller percentage of the final company you sell. Point is, you could have sold for $40 million in today's hot market and had a larger share of the company with less risk of losing it all in the new age of AI-enabled competitors. You're stuck working for many years more just to make these latest investors happy. Is that what you wanted? No. A better strategy is to look at selling earlier or doing a recapitalization to get some liquidity out, perhaps with a partner that can help you grow.